Hey everybody, my name is Brad, and today I'm gonna do, I guess in some ways, kind of a random video. Just gonna kind of talk through a few questions that I've gotten recently based on my last trade recap. Basically, yeah, just have some fun, talk some charts, and see where we get to anyway. So what we'll do is we'll jump on to Euro US dollar on the daily chart. This is where probably one of the biggest questions that I received came from. I think I got like 4 or 5 DMs about it, so I figured probably a good idea to talk about it on a video just to clarify a couple things. And the question really comes down to is, hey Brad, I watched your trade recap and I noticed on your daily chart some of the structure that you mapped out was different than mine. You know, I use certain swing points and it looks like you disregarded them. How come you did that? Well, I'll explain that, and we'll start with this little bit of structure here because this seemed to be where a lot of the confusion came from. So if we just take a moment to think about how markets typically work, or how they move more specifically, they're moving in a form of impulse, some sort of correction, and then an impulse. And what we want to see, or what a lot of the textbooks or fibs would say, is that this leg should mirror this leg, and that's just kind of what we have known to believe to be true, and in most cases it tends to be true to a certain regard. Price action isn't perfect, but we can use that sometimes as a framework to understand what's going on. But with all that said, you know, when we're looking at impulsive structures, something like this is a very strong move to the downside. You know, we have imbalance that's happening within this. We've broken structure to the downside. We've broken a fair bit of internal range liquidity. You know, we were initially bullish and we're moving to the upside, and then we switch bearish. And then we see this continuation, and then price drops. We formed this low right here, so it's only natural to view that as a low once price starts retracing to the upside. Now, a lot of people like to look at structural points and say a retracement is only valid, or a retracement is only true if on the daily chart, for instance, on your USD, price retraces about 100 pips. Now, for the most part, I follow that rule. I'm not as specific with the level of pips, but I do take note of how big the retrace is. But there's a couple other things that I like to see when it comes to retraces. I want to see a big enough retrace that looks like an actual pullback in structure and not just consolidation or some sort of correction. I want to see then price breaking structure to the downside or to the upside with actual intents if we are looking for a continuation. So if we're looking at this in specifics, we can see that we have this low. We break to the downside. The first few candles more or less respect the previous low, so nothing's really happened. We've wicked below, we've taken liquidity in essence. So if we're looking at that, you know, we would be just keeping mind of this high, because we'd be expecting if price is going to turn bullish, we would break that high. And we've gotten a liquidity sweep, so you know, we could be seeing a change of character before we get that break to the upside. And you know, that's all fine and dandy, but then what we see is we see this large wick, which again, we can start to say maybe that's a liquidity sweep, and we'd be looking for that change of character. We'd still be monitoring the highs, but then we break to the downside again because we have this bit of price action. Now, instead of mapping out my structure, I'll just grab a highlighter and doing something like this high. Then we have a break of structure. The real break and close would be something like this. We'd have this low, which, you know, as it's happening, I'd be viewing this as my current low. But then we start to ask ourselves, you know, what's going to happen next? And I think that that's one of the most important questions when it comes to looking at market structure or even supply and demand zones, is just really asking yourself what happens next so that we can make a logical trade decision. Now, one thing that I want to add on before I continue is when we're looking at breaks of structure, we want to see true follow through. We want to see something where, you know, we break structure and we continue. Now, if we look at something like this where we break structure, we don't really continue. We print this high, then we finally break structure. Is that an actual true continuation of bearish momentum? No, not really, because if we look, how much did price drop? It dropped about 115 pips, 111, 115 pips, you know, which is a sizable move to the downside. But if we're looking at something like this, you know, this is a 300 pip drop. And then we have about 130 pip retrace, and then price drops another roughly 195 pips or something like that. But more specifically, if we're just looking at it from this swing low and this, price doesn't really break it, struggles to break it. And what we see is once it finally does break it, we print this high. Now, what I like to see is when I see structure break, I want to see a true run to the downside and continuation. If not, if I see something more like this, it gives me one of two things. We're seeing that price is more or less struggling to break the low. What we're going to see more often than not is either a change of character to move to the upside or a sweep of liquidity and then a move to the downside, especially if our actual high is this point, because we're not actually using this point. While we might get a change of character, we're not actually getting a break of structure. And I think that's one of the most important things to understand when we're looking at breaks of structures and changes of character. They are very different things. The changes of character give us those early warning signs or those early indications that the trend might be changing and that we might be able to flip our bias or look for a pullback or things like that. But a break of structure starts to give us an actual confirmation that the trend is in fact changing. So if we're looking at this bit of price action, I've seen a lot of people looking at something like this. Price was breaking to the downside. Once we broke here, we switched bullish, and then a lot of people would be looking for buys in that particular area, which there's nothing inherently wrong with that, but this is just something that I've started to really take note of over the last several months on mapping market structure. If we don't get that true continuation, we don't get that true break to the downside in this case that shows momentum, chances are, you're going to get caught with your pants down, so to speak, with market structure, because if we just look, we just barely break the structure, we retrace. So if we're just looking at this, let me take this step back. I'm kind of rambling a little bit, but I want to make sure that I explain this in the best way that I can. So we have this low, we break it just barely, but we don't actually break and close below. We get a reaction, we print this high right here. And what I'll do is we'll just put a highlighter and I'll change it to make it nice and vibrant, make it pink. So we've broken to the downside, struggled to break. We haven't continued. We printed this high, then we move back to the downside. So what this tells me when this sort of phenomena starts to happen is I'm aware of this high that's printed, but not for the reasons of mapping out market structure, but instead I'm asking myself, why did this high get printed in this market, especially given the way price action is? Because if I take a step back and start to ask myself, what's forming? Some of you might cringe when I draw something like this, but we'll just do this. We'll go default. That's fine. We start drawing something like this. What is this? It's trend lines. It's a descending channel. Anyone who's traded patterns, I came from some patterns I integrated with supply and demand, but that's for a different day. A lot of people would be expecting price to break to the upside and continue and basically create some sort of reversal. And, then we'd be looking for moon vibes. And what we can see is people get caught with the pants down. So now that we see this next reaction, we break that structure. So what I'm also looking at is these highs. These highs are standing out to me, not for structural reasons, but more for liquidity purposes. This, in essence, is internal range liquidity that's specific to this range in price, this downtrend, this little bit of price action. So what I'm looking at now is, again, we see price break to the downside. We're not breaking and closing below. At least with this bit, we break and close below, but we hardly break and close below. Like we break to the downside and then we immediately retrace with force. So that shows me the bear trend is just not willing or not able to take over. So I'm just going to put this here and then we'll keep that green. Now we'll throw that on too, just to keep it. So this is how a lot of people would have their structure mapped out. And again, there's nothing wrong with it. It's just about how can we clean this up? How can we make this a little bit more easy to navigate? So what I have is, first of all, a bunch of dots, gray, pink, and green. And what they're representing is, potential swing points for structure when we're looking at this downtrend. And the pink ones, of course, could be potential highs within structure, but more specifically, how I'm viewing them are as liquidity points. And what we can see is, obviously, when we're looking at this, we have hindsight on our side at this point to explain this, but as this is happening, I'm still mapping out my structure this way. The only difference is I'm still aware that we have a low here, we have a high here, and basically the structure that's forming here is, in my mind, one larger impulse until I start to see something that stands out to me. So what I'd be looking for if I were to ask myself if this is actually going to go bullish, I want to see this high go. But what I can do is I can start looking at changes of character on the lower time frames and see, okay, we get a change of character. Now, do we follow through to break the structure? Because then that's a more confirmed trend switching from bearish to bullish. But in this case, we don't get that. But what do we do? And this is the most specific part, and this is why I've called out these highs specifically, because if we get a reaction to a level, in this case, a level of structure, and it doesn't actually do what it's supposed to do, which is continue, because we're in a bear trend, we're expecting that when price retraces, we're going to continue to the downside. We have that impulse to the downside, some sort of correction, and then another impulse. We want to see that if we're in a true continuation setting. If not, we might get some sort of complex structure, which is going to throw off a lot of people, but that's okay. Because now when we see a break of structure, we get basically a failed reaction to breaking that structure. We haven't actually closed or broken structure in a tangible way. We're printing highs. What are these highs mostly going to be? They're going to be rated as liquidity. And this is, if we go back to the liquidity videos in the refined series, this ends up just being trendline liquidity. Now, of course, we have all of this that we could use as trendline liquidity, but what we can see is these ones specifically were created basically for liquidity. When we see structural points, when we see supply and demand zones, we need to ask ourselves, why were these created? Why were these reactions to zones created, or why were these reactions to structures created? Because once we can ask those questions, and once we can begin to figure that out, then our trading process becomes a lot more manageable, because we're asking the right questions and reviewing things. Because it's so easy to look at a chart and map out your structure, map out your supply and demand zones, and then basically trade everything without really thinking critically about it. You know, a lot of people are up in arms about discretion, and you shouldn't trade with discretion, but I think you should to a certain degree, because that's what allows you to see this sort of concept being, what are these highs being created for? Because we're not actually getting true structural breaks. Are we reversing? You know, are we going to start moving to the upside? Maybe we are, because now we're starting to see a change of character, move to the upside. You know, we want to see an actual true structure break, because right now all we've done is we've created liquidity. We've swept that liquidity with this. If I just clear up all these squiggly lines, and what we can do is we'll draw in a zone right here. This would be a supply zone, more of a refined supply zone. You can see as it's a doji. What is a doji on a lower time frame? It's a range. What is a range? A range indicates buying and selling in some sort of fair value, which means interest. So we can pair that with everything that we're looking at to see that price probably is going to mitigate that and then continue to the downside. So to summarize all of this, although these retraces here, I have a bubble for these particular ones, which we can talk about as well. But in this case, the retraces are pretty small. We're struggling to break structure to the downside. We break it and then we immediately shoot back up. We're not continuing to the downside in a nice trending manner. So basically what I'm doing, or what I'd like to do, is I map out those highs, I map out the lows. I'm still aware of them, I'm still watching them, and I'm asking myself, why are these highs being created when we're still in a downtrend and we're failing to break below tangibly these previous lows? Chances are that those highs are going to be taken as liquidity. What do we see? Price takes those highs as liquidity and then continues to run to the downside. We can take that a little bit of a step further and start just studying the next bit of price action. And what we see is we get a nice impulse to the downside. We get a really clean retrace. There's no doubt in my mind that this is a clean retrace. You know, it's almost 100 pips. So if you follow that 100 pip rule, you'd be looking at this as a nice clean retrace. You can't argue that that is a retrace. That's just what it is. But now we take kind of the second end of that and say, you know, what happens next? We break structure. And the initial one, we struggle to actually break and close below. We have this doji. We get a little bit of momentum, and then we get a bullish candle, and then we start to fire back up to the upside. Now, a lot of people, rightfully so, looking at this, would view this as a break of structure to the upside and turning bullish. And to a certain extent, I would agree 100% with that. But then what we start to ask ourselves is, if we look at this move, it's about 200 pips. The retrace itself is about 100 pips, and then move to the downside, it's about 140 pips. So we have pretty strong indication that this is a continuation. But then we got to ask ourselves, you know, how did that structure form? And this is where we get a little bit nitty gritty in the candles. It's going to take some testing. It's going to take some time to fully understand this. We initially break with a doji, we get some momentum, and then we immediately retrace to the upside. So what that tells me is this high is important in terms of it's probably going to be liquidity. But what we can say too, if we just, don't like kind of that methodology being like, well, I don't know if this is going to be liquidity or we're going to mitigate and then continue to the downside. I don't want to miss a trade, blah, blah, blah. Well, first of all, don't get that fear of missing out. If you miss a trade, it's fine. But what's more important is understanding what's happening, going, okay, this is a break to the downside. If we break this, this is a change of character. This is a true break of structure. You can also use this as your true break of structure because it is a swing point. But be aware or be mindful that a true significant break of structure is probably going to take place at that key high because of this little bit of price action within the break of structure itself. So what we can end up seeing is price does seek this high as liquidity, and we'll put that little pink line there, or pink circle rather, and we see that price basically hunts this as liquidity, and then we move to the downside so we can throw on some sort of zone. Again, how you draw this one is a little bit up for interpretation. We can pretty much just take this entire range, because basically what this candle formation is it's a range. Again, interaction on the lower time frame. This is where you're showing the balance of supply and demand at that particular price level. There's a lot of orders changing hands. If we start to take this a step further, we have a little bit of a supply chain starting to take place. We mitigated this supply zone, created this supply zone, we've mitigated this, and we're continuing to drop to the downside. So we're starting to see that supply is still very much in control. And even if we just move over here, we can see that we have supply here, we tap in, and then we continue to the downside. And then we're just continuing that process once more. We take this high as liquidity. So what you can view this as is one large impulse. And what does that start to give us? So if I just make this a little bit smaller, impulse, correction, impulse, correction, impulse, really deep correction. Yes, we do sweep a little bit of liquidity, but again, we're for the most part respecting the supply zone, and then we move to the downside. Now, if we look at this bit of price action, this starts to change kind of the methodology or just kind of the approach, because initially what we can see is, we create a low and we break that low. How big is the pullback? The pullback is about 80 pips, 75, 80 pips. And then how big is the move to the downside? It's about 112 pips. So again, pretty reasonable retrace, pretty reasonable bit of price action. But what we can see again is we ask ourselves, what happens next and what does that mean for us? So we break to the downside. We have a large wick. We start to consolidate. And if we just look at internal price action, this is probably going to be some kind of change of character on a lower time if we just kind of look away from this wick, so to speak. But even that aside, because that might be a little bit confusing, and that's totally fine, we got to ask ourselves, we've broken this structural level. We're expecting that price should continue to the downside in some tangible way. We want to see strength, because we know that if the market is going to move, we need to actually have money and orders and liquidity pushing the market to do something. And if the market is unwilling to move in a tangible way, chances are, something else is happening. So what do we gain from that? Again, we can look at this high as two things. We have liquidity. Chances are that because this reaction was so poor and that we really didn't break structure in a really key or tangible way, that this high is probably going to get run as liquidity. But again, when we're looking at this bit of structure, if we're looking at our structural range, we're trading through something like that. If I can draw straight, there's our highest high of the range and our lowest low of the range. We can say that this is now a change of character on the daily chart. So we're starting to see some bit of indication that we're moving to the upside. So what you can see is I do have indication of daily bullish market structure, but I'm still looking at this in a bearish sentiment, because even if we come to the upside, we can take this internal range liquidity, we can tap into something like this POI, and still continue to drop. Why? Because there's a lot of room for that. If we went to the weekly chart, and we talked about this in the previous video, we have this range right here that I drew. There's still a lot of room to move to the downside. We're pretty bearish. And if we look at some structural bits, we broke this low. What did we do? We failed to break initially. We just took the sweep, and we ended up just targeting some liquidity, and then we continued dropping this bit. And this is why this is so powerful, looking at the daily and kind of just looking at things in a different light, because on a weekly chart, we would most definitely use this as one actual impulse. If I just go back down to the daily chart, what we can see is that bit of complex structure that we were looking at is just part of the impulse in the weekly. And what we're able to do without even looking at the weekly chart is we've been able to dissect this move and understand that it wasn't a reversal, it wasn't a change in trend on the daily chart, and it was actually just a part of the impulse on the weekly chart, which is why if we're looking at that, we wouldn't get caught out on this little sweep essentially, or break of structure as it seems on the daily chart, or what it's kind of indicating, because we had this low, we had this high, we had that change of character, we didn't break any tangible structure, because all of that is just part of the impulse. Then we get some sort of retrace, and then we continue on to the downside. So if we're just looking at that from a weekly perspective, that's exactly what I drew earlier to a certain extent. Obviously we had a little bit of structure. Oops. We had a little bit of structure here. So let's just delete that real quick. We were able to dictate that as a little bit of daily structure, which helps us refine some of the levels that we're looking at. And we have this as one full impulse. We had a retrace, and then a full impulse, a really, really deep correction, which is why you could, in theory, almost classify this as one large impulse, or more specifically, even something like this, which if we go back to the weekly chart, that's why that is one big impulse. So basically what this whole process is, and I hope I've conveyed this in a meaningful manner, is that we can look at, say, a daily chart and understand what's happening, what is a break of structure, what isn't a break of structure, and what we're actually just doing is showcasing what the weekly order flow is showcasing. I said showcasing many times there, but we're seeing what the structure is on the weekly chart. We can see that it's very strong bearish. We just have one strong impulsive leg to the downside. And what we're looking at is just one complete leg in price. On the daily, obviously the structure is a little bit more defined, and what that allows us to do through this process is understand what more true structure is and what more fake structure is that's going to be used as liquidity. This might seem a little bit complicated initially, so I hope I've been able to explain this in a meaningful manner, but basically the summary of what I've just kind of explained is when we're breaking structure, we want to be mindful of how we break structure, because if we give some sort of reaction, chances are we're probably going to sweep those reactions, because if we start to see this bit of corrective market structure, I'm going to draw like a descending channel or some sort of channel just to kind of articulate it a little bit, but we're going to create short-term highs, and then we're going to run those highs more than likely, because those highs were created in essence for the sole purpose of being liquidity to fuel the move further, because we know that the market needs liquidity or fuel to move to the upside, to the downside. We need orders to change hands in order for the market to move. That's why the market's moving. So when we think of it in that light, why are certain highs being created? Why are certain lows being created? Why does sometimes structure in some ways seem incredibly confusing? Why in some respects do we have bullish structure being created when we're in bearish structure? We take that new bullish structure, but then all of a sudden we switch back bearish. Now you're caught with your pants down because you were looking to buy in here, it didn't work. And then, same situation here, we switch bullish and you were looking to buy in here. Maybe you got a nice lower time frame entry here, but the trade didn't play out and you're fighting momentum in that case. Just kind of look at it in that lens, look at how we're breaking structure. When I see price starting to get super corrective like this, that's when I start to include it in one impulse. But again, I'm still mindful of all the structure, because what it's doing is it's allowing me to understand the highs in this case, because it's a downtrend, what the highs are doing, and the fact that the likelihood of them being run or taken as liquidity is increasing as price continues. And that's the sole purpose of these types of corrections, or any corrections in that case, because at the end of the day, we need liquidity. And what better way to do it than to create these patterns? There's a lot of people that play patterns. There's a lot of people that play support and resistance, because if we look at, this support level, we take support. We have this pattern. A lot of people are taking buys. Maybe some get some profit. People are greedy. They'd be targeting these highs boom, they get taken out, and then people are looking to sell, boom, they get taken out, and then, we all understand liquidity to a certain extent. It's just about looking at it in different lenses. When it comes to your previous trading strategy, some people, feel that they have to totally forget everything that they have done in their trading journey. I don't believe that's, an important thing. I actually think that, if you've come from support and resistance, if you've come from patterns, if you've come from harmonics, if you've come from whatever else that you've come from, you can use that experience to understand where liquidity is likely going to be in the market so that you can make better trading decisions. Because if you start seeing descending channels, for instance, but we're in a strong bearish trend, or mapping out market structure the way that we map it out, we can start to, gauge whether or not that's descending channel is actually going to play out as a reversal point. Because then we ask ourselves, where is this reacting off of? Yeah, we could argue that maybe this is a demand zone, but when we're looking at it, does this form nicely? Yeah, it takes out a little bit of liquidity. We have a somewhat decent move that breaks structure, but does it really have much else going for it? Probably not. Then we kind of just look at it in a more critical manner. Does this make sense? Does this not make sense? It's all about asking ourselves, what's happening next? Why is this happening? We're always asking those questions. Why? Mark things up in real time as you normally would, but then I think the biggest thing is don't fixate on those markings like they're an end all be all, because sometimes you can mark something and it makes so much sense at that particular moment in time. But as the market is constantly evolving and printing new candles, the story is changing, and we need to pivot with that. We should be in the mindset that, yes, we want to forecast price to a certain extent. We want to have an understanding based on all of our analysis where the market is likely to go, but we can't be so caught in the mindset of, I need to forecast this 1,000 pip move to the upside, that I'm totally not focused on the possibility that price can continue to the downside. What we need to do is be more reactionary to what's happening in the markets, with a little bit of forecasting, of course, because the forecasting does frame our minds and subconscious to understanding where the market could go. But at the end of the day, we need to react to what the market is actually telling us, because as soon as we start forcing our own perspective or bias on the market, that's when trading gets incredibly difficult, because we're no longer trading based on what the market's telling us. We're trading based on what we're trying to tell the market to do. And if you've ever done that, and I'm sure many of you have, it doesn't work. In more cases than not, you're just going to get hit by the market over and over and over again. So I hope that this video was helpful. I'm going to stop waffling, but basically, just how we can identify structure. This works on all time frames. This is how I view market structure. If we start to see that really corrective behavior, I start to include that all as one impulse. It just makes things a little bit more manageable. It makes things easier to read, because if you're constantly looking at, oh, that's a break structure to the downside, we have this high, we'll break structure, we break structure. Oh, we break structure to the downside. Now we've broken structure to the upside. Now we're bullish. Let's look to buy. Oh, I got spanked out of that. Boom, we break to we're in a downtrend again. I'm going to look to sell. Oh, I missed. We didn't quite get into my, point of interest to sell, my supply zone. Oh, we broke to the downside. So now I'm going to look to sell here. Oh, I got taken out. Oh, we're bullish now. I'm going to look to buy here. We come to the downside, and the cycle just keeps repeating. Now, if we ask ourselves, how are we breaking structure? How much power are we breaking structure with? Now we can start to ask ourselves, why are these highs or why are these lows being created? And it just opens up a different conversation when we're navigating the charts. So I hope that was helpful.